Let me show you a balance sheet. This is the balance sheet of OZ company. And the first thing that I want to show you is here. Balance sheet at 30 June 2010 and 2011. So it's at a point of time. So it's a date. It's 30 June of 2011. So it's different from income statement that is over a period of time, like 3 months, 6 months, or a year. So it's at a date, like it's at a specific point of time, 30 June 2011, right? So on the left side of a balance sheet, you can find all assets that a company owns. Asset means whatever a company owns. And here, as you can see, for the assets, we have, in a balance sheet, we have grouped them into two categories: current assets and fixed assets. Current assets means assets that their life is shorter than 1 year. Actually, 1 year is the threshold in finance to say something is short-term or long-term. So for assets, any asset that its life is shorter than 1 year, we consider it as a current asset. And for fixed asset, we mean any asset that its life is expected to be longer than 1 year. And we name it fixed asset. So as you can see here, we start always in reporting, when we report in balance sheet, we always start with the most liquid assets. And the most liquid asset here is the current asset. And then we have the fixed assets. But for current assets also, there are several items in this group, and like cash, account receivable, and inventory. And again, for these items, we also start with the most liquid one. So the most liquid one is cash. What do we mean by liquidity? It means how fast you can convert something into cash at a price very close to the market price. So when we talk about liquidity, it means converting into cash. So all these items, we expect to be able to convert them into cash in less than 1 year. And which one is the most liquid one? Of course, cash, because cash is already cash. Cash is already cash, and it's already have been converted into cash. Actually, it's the same thing. So it's the most liquid one, so it will be reported as the first item. Then we have account receivable. Account receivable means the money that you need to collect. You will collect from your customers for your sales. So you already sold something and you want to collect your sales. So you expect to receive the money from the customers in less than 1 year. So we named it as account receivable. Then we have inventory. For inventory also, we expect to convert it into cash in less than 1 year. Okay. Because we missed it now. Okay. So, and then we have the total of all current assets. So when later you check balance sheet of companies, you will see it's more details and there are more items there. So it's a simplified version of balance sheet. And then we have fixed asset. For fixed asset here, we have net fixed asset, but there may be different types. And the total of current assets and fixed assets is total assets. So we have the total assets for 2010 and 2011. And as you can see, it has increased. So on the left side, we have all assets. What do we have on the right side of the balance sheet? On the right side, we report how we paid for these assets, how the company paid for these assets. The company already bought different types of assets, right? And now how we paid them. So there are two main sources of finance to pay for assets. Number one is debt or liability. Means a company may borrow to pay for these assets. And then we have shareholders' equity. Means the money that shareholders or owners bring to the firm. So for liability, we have, again, current liability, as you can see here, and long-term debt. So current debt or current liability, and by current we mean the life of these debt instruments or these liabilities is shorter than 1 year. It means you have to pay off this debt in less than 1 year. An example can be account payable. Account payable means the money that the company needs to pay to its supplier, and it's expected to be less than 1 year. And then notes payable means the money that the company borrowed in a short-term period of less than 1 year. And then we have total of current liabilities. Then we have long-term debt. Long-term debt means borrowing for more than 1 year. Maybe a long-term loan, 5-year loan, or maybe bonds. When a company wants to borrow, they may issue bonds and borrow for 10 years, 20 years. So those with a life longer than 1 year will be reported under long-term debt. Again, this is a simplified version of a balance sheet. So later when you check balance sheet of companies, you may find more items. But actually the idea is the same. So on the left side, we have assets. On the right side, we have how we finance them, how we pay for them. And we start with debt. For debt, first we report the current liability and the shortest, the most liquid debt instrument, most liquid liabilities. Those most liquid, those with the, sorry, not most, those with shorter life. And then we will go for long-term debt. And why first we have liability and then shareholders' equity? The reason is because the idea behind it is if you sell all assets of the company, then you need to pay to the debt holders. You need to pay to those you borrowed from, right? So you pay off all debts, liabilities, and whatever is left, which is called residuals, whatever is left will be paid to the shareholders, to the owners. So it's at the bottom of the right column. So all assets will be, if we sell all assets, we pay off all liabilities, and whatever is left is shareholders equity. And for shareholders equity, as you can see, we have common shares, ordinary shares, and we have retained earnings. And here, as you can see, okay, the total liability and total equity, when you compute, it will be the same as total assets. So you can read it from here. It's 2,756 for 2010, and it's the same amount for assets for 2010, and it's the same amount on the right side. This is the reason we call it balance sheet, because it's balanced, right? The left column and right column are balanced. For 2011, it's the same again. You see, it's the same figure. And they have been reported in $1 million. Okay. Now, one more thing I want to mention is about assets. We can also categorize assets into two general forms. Assets can be tangible, like, for example, a computer or maybe a building, machinery, or it can be intangible, like, for example, trademark of a company. And again, based on their life and how fast we expect to be, and that they expect them to be converted into cash, we can divide them into current assets and fixed assets. So this is a balance sheet.